Welcome to Spidell's California Minute. I'm your host, Catherine Zidane. This week we're covering California's recent conformity to TCJA alimony provisions and which taxpayers are affected. Get a complete rundown of California's conformity bill at Spidell's Federal and California Tax Update. You can attend an in-person seminar or a live webinar session, and dates and details are available at spidell.com. With the passage of SB 711, which updates California's specified conformity date to January 1, 2025, California conforms to the Tax Cuts and Jobs Act treatment of alimony beginning with the 2025 taxable year, but only for some taxpayers. This means that for these taxpayers, alimony payments are non-deductible by the payor and excluded from the payee's income. This only applies to alimony paid as a result of any divorce or separation instrument executed after December 31, 2025, or any divorce or separation instrument executed on or before December 31, 2025, and modified after that date, if the modification expressly provides that this new conformity provision applies to the modification. Taxpayers are now going to be required to report the month and year of their divorce or separation agreement on their Schedule CA. For taxpayers whose divorce or separation agreement was executed prior to 2026, the payor may still deduct the alimony payments on their California return, and California resident payees are still required to report alimony received on their California return. Alimony received by a California non-resident is not taxed by California, even if the payor deducted the income on their California return. It's going to be important for tax professionals to examine their clients' divorce or separation instruments going forward to determine the proper tax treatment of these alimony payments, depending on when the instruments were executed. For instruments executed prior to 2026 and not modified to conform to the current federal and California treatment, tax professionals should still follow pre-TCJA law to determine if alimony is deductible. Under pre-TCJA law, in order for alimony to be deductible by a payor, 4 requirements have to be met. The payment is received by a spouse under a divorce or separation instrument. The divorce or separation instrument does not designate the payment as a payment which is not includable in gross income and not allowable as a deduction under pre-TCJA law. The payee spouse and the payor spouse are not members of the same household at the time the payment is made. And there is no liability to make any payment for any period after the death of the payee spouse, and there is no liability to make any payment in cash or property as a substitute for payments after the death of the payee spouse. Payments are not alimony if the divorce agreement fixes any part of any payment for a child's support in dollar amount or percentage. Payments that are child support or in lieu of child support are not includable in the recipient's income and not deductible by the payor. The intent of the taxpayers as to whether a payment is alimony does not determine deductibility. The 4 tests provide a straightforward, objective manner of making that determination, and all 4 requirements have to be met. Spidell's analysis and explanation of California taxes is the most complete and best-priced California tax guide available, and it's currently being updated to reflect 2025 law changes, including the new conformity bill. You can pre-order a print or online version of the 2026 edition at caltax.com under Publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.